Silicon Valley is building trillion-dollar digital empires that are about to be offline for the next 3 years. For nearly 2 decades, a magnificent illusion dominated the global economy, convincing humanity that technological progress had finally separated itself from the physical limits of the planet.
But there's not just opposition to data centers like this. There is a more significant, perhaps, opposition to what it's going to do to society.
We were told that information was weightless, that the internet existed in a frictionless cloud, and that trillion-dollar empires could be constructed out of nothing more than pure mathematical logic. Today, that illusion is dead, and this structural breakdown maps the exact physical wall your career and capital are about to crash into. Behind every elegant software interface lies an insatiable industrial beast that eats electricity and devours massive quantities of raw metals just to keep its eyes open.
Software production, it was done by humans typing. Now we have a new industry, and this software is produced with machinery. So you need a large supercomputer. You apply electricity to it,
creating a brutal corporate trap that is actively closing on white-collar offices, heavy infrastructure grid corridors, and your personal savings accounts. The number? 400 billion. $400 billion is the estimated capital expenditure illusion now sitting completely idle in global corporate warehouses, waiting for a power connection. This structural crisis reveals itself clearest inside white-collar offices and across heavy factory floors, where the grand dream of total algorithmic labor replacement has shattered against a hard operational ceiling. For years, corporate executive suites pursued aggressive restructuring policies, executing widespread white-collar workforce reductions on the absolute assumption that generative artificial intelligence models could seamlessly absorb clerical, middle management, and complex analytical workloads. But this rapid transition has collided with a persistent operational boundary known as the 60-40 algorithmic gap. Statistical evaluations of enterprise deployments reveal that while deep learning systems can successfully automate approximately 60% of high-volume, highly repetitive digital workflows.
I think with AI, you are going to start seeing actual change in how workflow happens.
They catastrophically fail at the remaining 40% of complex, real-world edge cases. When unsupervised software produces completely fabricated, incorrect information, the resulting operational, financial, and legal liabilities operate like a medical examiner's report, exposing the rotting core of hasty corporate downsizing. In a striking case study of this operational inversion, Ford Motor Company was forced to quietly re-enlist over 350 veteran engineers, historically referred to as graybeards, to manually oversee physical quality assurance checks on vehicle assembly lines. The company discovered that automated computer vision units and factory floor scanners routinely misread subtle physical micro-defects and micro-tolerances, accumulating billions in potential warranty liabilities. The transition had replaced legacy human tribal knowledge with automated scanning systems, leading to severe quality control leaks that threatened to accumulate billions in potential warranty liabilities. Bringing those graybeards back to the floor restored manual checking processes that algorithmic software was completely unable to replicate. The number? 32%. That is the share of hiring managers who eliminated human roles for artificial intelligence, but are now actively rehiring for those same exact positions. Additionally, 55% of global enterprise executives admit that their rapid workforce downsizing completely failed to generate a true return on investment. These corporate reviews, conducted by independent groups like OrgView and Forrester, reveal that the automated workplace is rapidly returning to human hands, as advanced teams realize that software errors destroy enterprise margins. Gartner's long-term labor forecast projects that the percentage of automated customer support and roles expected to return to human workers by 2027 will clear over 50%.
Some of these things do something called hallucinating, where they will literally start writing crazy things.
This labor margin inversion occurs as advanced teams realize that software overheads have become highly volatile. Brian Catanzaro, the Vice President of Applied Deep Learning Research at NVIDIA, bluntly demonstrated that for advanced computational tasks, raw compute costs now vastly exceed the overhead of human employee salaries, forcing corporations to optimize for human-machine hybrid workforces rather than pure automation. Returning employees tasked with auditing, correcting, and managing failed algorithmic systems are commanding significant salary increases over the legacy roles that software was meant to permanently delete. Yet, this restaffing wave has exposed a critical labor imbalance across the macroeconomic landscape. Because companies spent years automating junior-level clerical, research, and coding tasks, they have inadvertently hollowed out the entry-level corporate ladder entirely. By deleting the junior training steps, the tech sector has created an oversupply of unusable entry-level talent, paired with an acute, hyper-expensive deficit of experienced human specialists. This structural talent fracture leaves major firms completely dependent on an aging pool of elite operators, even as the broader computational paradise turns into purgatory due to severe power and resource shortages. The number? 48 months. That's the absolute procurement lead time for a single massive substation grid transformer today. And the price to run these? £13,000 sterling. The price of a single metric ton of physical copper on the London Metal Exchange, up 41% a year ago today due to the rise in AI. The price is not keeping up with real-world demand, and a roadblock is reached. Large-scale data center projects designed to scale within 18 months are routinely delayed for years, waiting for basic physical grid equipment to arrive because the primary gatekeeper of the digital future is not a brilliant algorithm, but the unglamorous, oil-filled, large power transformer. These massive steel enclosures require specialized grain-oriented electrical steel and skilled winding labor, resources that are in critically short supply globally due to factory limits. At the same time, the raw material intensity of the computing revolution has triggered an acute global copper squeeze. High-density data centers require between 27 and 33 tons of copper per megawatt of applied power, nearly 3 times the material intensity of legacy web facilities. A single next-generation hyperscale site can devour up to 50,000 metric tons of physical copper. While software developers can design and deploy a new model in a matter of weeks, discovering, permitting, and constructing a new physical copper mine takes nearly 23 years. To bypass these terrestrial gridlock points, technology giants are actively seeking radical off-grid alternatives. Tech conglomerates are bypassing public utility monopolies entirely to purchase dedicated nuclear baseload capacity or contract directly with small modular nuclear reactor factories. In extreme cases, venture-backed consortia are investing in ocean-powered supercomputing nodes. Panthalassa, a startup backed by Peter Thiel.
And so the smart money, billionaires like Elon Musk and Eric Schmidt, now Peter Thiel, they're betting on putting GPUs beyond land. Today, Panthalassa, it's a wave energy startup. It's coming out of stealth mode with a $140 million round led personally by founders' funds. Peter Thiel
raised $140 million in a Series B round to push its valuation to $1 billion. deploying pilot nodes in the northern Pacific that use ocean wave motion to power onboard chips and Starlink satellites to transmit processed data back to land without drawing a single megawatt from public utilities. But this physical infrastructure wall has already triggered a severe capital expenditure reset, exposing a deep balance sheet discrepancy where delayed grid connections forced firms to write down billions in idle silicon inventory. Private technology and space infrastructure entities have entered a frantic pre-IPO valuation sprint. To sustain the multi-billion-dollar requirements of frontier computing, institutional asset managers are utilizing private liquidity gates. This backdoor systematically channels legacy retail retirement wealth, specifically target date mutual funds and 401k allocations, directly into highly illiquid private equity secondary markets. If these capital-intensive business models fail to generate cash flows sufficient to support their physical overheads, the resulting write-downs will trigger severe retirement shocks across the population. Institutional asset managers are utilizing private liquidity gates. This backdoor systematically channels legacy retail retirement wealth, specifically target date mutual funds and 401k allocations, directly into highly illiquid private equity secondary markets. If these capital-intensive business models fail to generate cash flows sufficient to support their physical overheads, the resulting write-downs will trigger severe retirement shocks across the population. Ultimately, the post-frontier era represents a profound return to the physical baseline of power. The future does not belong to the developers who write the most elegant mathematical code in a vacuum, but to those who control the raw materials, secure the physical energy baseload, and lay the heavy physical groundwork to power the machines. We must challenge the illusion of friction-free progress and prepare our assets for a world where physical constraints dictate digital dominance. If you are ready to track the deep architectural shifts rewriting our global economy, subscribe to the Prime Meridian today and prepare for the structural realities of the post-frontier era.